You welcome once again to another episode on our accounting tutorials or principles of accounting. Today, what we are going to study is linked to a previous video that I did on the treatment of bad debt and provision for doubtful debt. So today, what I want us to link to what we studied yesterday is recovery of bad debt. Recovery of bad debt. The steps involved in the accounting treatment. So a company pronounced some of their customers, or they wrote some of their debt off, or they pronounced some of their customers that they will not be eligible to pay the debts they are owing the entity. And on another circumstance or another situation, we saw that at the end of the year, one of the customers or some of the customers we wrote as bad that they wouldn't be able to defray their debt, they come back and tell us that we will pay on various conditions that we said. Maybe the person was infant. Right now, although the person is infant, the person is minor, but he has the capacity to defray the debt. What are the accounting treatments? So this scenario will come in two main phases. The first one is whereby the customer is ready to pay without instant cash or check. And two, the customer is ready to pay with instant cash or check. So the first scenario is where the customer is ready to pay without instant cash. He or she has just notified the entity. He has notified the entity that, okay, I was owing you right now. Give me 3 months, I'll be ready to pay. And when it happens like that, you already wrote the debt as bad, which occurred as an expense in your books. How are you going to reconcile the previous debt you wrote as bad not to be bad again? And the second scenario is whereby the customer is ready to pay with instant cash or check. After notifying you, he comes to your place, your entity, your premise, and say that fine, although you wrote my debt as bad, I'm back from abroad, I'm back from my inconveniences, I'm ready to pay. This is a check, this is a fiscal cash. What are the treatments? So treatment. So the first one that we are going to do is a situation whereby the customer is ready to pay without instant cash or check. He's not having money, but he or she has notified the entity that he's going to pay. What are the one? If the customer is ready to pay without instant cash, there are two accounts that this transaction is going to affect. So initially, it will affect the receivables account, account. And two, we are talking about bad debt. Therefore, it will also affect the bad debt account. The customer is ready to pay. The customer is not ready to pay. So initially, if you remember, when we write off a debt as bad, what we do to the receivables account, we less the bad debt from the receivables account. But right now, we have to reinstate the debt again to increase the amount of money we are expecting from people who are owing us. So if a customer is ready to pay without instant cash or check, it is going to increase the receivables account again. The amount of money we expect in the future economic money we are expecting for people who are owing us. So if it's going to increase, what we do is I say debit account receivables. And the person's debt is no more bad, which means that the bad debt that we've already written in this book, it must be reduced. So if it's reducing, we say we credit the bad debt account. If we are debiting the receivables account, it means we are adding additional debt. Right now, the person is ready to pay. The person has come to us that I'm ready to pay, but I don't have the cash right now. So we are canceling the debt that we wrote. So it will increase the amount of money that our receivables are owing us. And indirectly, or in a dual concept, or in the double entry concept, it will reduce. So we say less or subtract. Subtract. If it was supposed to be a T account. So imagine the receivables account that you have. The final one that you have, receivables. Receivables. The final one you've got in the final, meaning you've deducted bad debt provision for that, for that is 2,000 cedis. And right now your bad debt expense is 500 cedis. Someone who is owing you 100 cedis that you wrote off, the person has come back. What is going to mean is that right now our receivables will increase to 2,100 and the bad debt will reduce to 400. That's all. That's for the first treatment. If the person notify you without bringing cash, notify you, is going to affect the receivables account and the bad debt account. Let's work for a situation whereby the second condition, where the customer is ready to pay you with instant cash or check. What will happen? The second condition. This one, since the person is ready to pay, already it has been taken from the bad debt was taken from the receivables account, and he is coming to pay. So his name, he is not just notifying you. If he is coming to pay, it's going to affect the bad debt account and cash or bank. The person ready to pay, instant check or cash. Since you are going to receive money with instant cash or check, since we are going to receive instant cash or check, it means our cash or bank account will increase. So we will debit cash or bank, and bad debt is going to reduce because the person is now coming to pay. We credit the bad debt account. So in a nutshell, in a layman's view, what we are doing is that we are adding the amount of money that the customer is bringing to our cash or bank account. Then we do what again? We less or subtract. So we add, here we add, and here we less from the bad debt. Because bad debt account is going to reduce because one of them is ready to pay this amount. So the only difference between the first condition is that since the first condition, the account that is going to affect is the account receivables and the bad debt. And the second condition is going to affect cash or bank and bad debt. Know the difference. Know the difference. If the person is paying with ready cash or bank and bad debt. If the person is not ready to pay with instant cash or check, then it will be the receivables account and bad debt account. Thank you very much. If you have any issue, you can put it down in the comment box and I will serve you right. We will continue with another episode on this short final account. So all these scenarios are disjointed issues in final accounts with a sole trader. Thank you very much.